Okay, so let's get started on the Unit 4 part of the course. So we're going to look at non-current assets. So depreciation is the first part, which part you did in Year 11. And then we move on to the disposal of non-current depreciable assets as a new topic for you guys from Year 11. So let's go on to the first part. So the first thing we're going to look at is the definition. So assets versus expenses. So an asset is an economic benefit which is yet to be consumed, whereas an expense is the consumption of an economic benefit. So they're closely related. So assets will continue on into the future, where expenses have been consumed in the current period. So obviously reporting period, accrual basis, faithful representation, and relevance are all big players in terms of the accounting assumptions and qualitative characteristics. A non-current asset, an economic resource that will produce future economic benefits. The intention is to keep these assets for a number of years, and they are not for resale. Right, so this point here, we don't intend to keep these assets to sell them. They might get sold, but that is not the intention. So we're going to look at depreciable assets. So not all assets are depreciable. So obviously current assets are not depreciable. Some non-current assets are not depreciable because they actually do the opposite. So they appreciate. So in particular, I know we've got a pretty significant economic downturn at the moment, but generally land will increase in value over time. So you would not depreciate land. But most other non-current assets are depreciable, so the usual suspects will be furniture and fittings, computers, equipment, vehicles. So that type of non-current asset will have its economic benefit consumed over time. Right, to start the ball rolling, let's look at the initial part of it, which is the purchase of a non-current asset. Right, the key thing here in Year 12 is that it's only for cash. Right, so what I do not want to see anywhere is any reference to accounts payable in this topic. Right, so we do not want a cross-reference to accounts payable anywhere because it is only cash purchases. Right, so yes, it says invoice on a lot of the documents you'll get in this chapter or this topic, but you'll notice that nothing's owing, right? So it means it's always been paid and paid for in cash. So never ever go to accounts payable. And this took me a lot of time and effort with last year's group to convince them that when they got a document like this and they were buying a non-current asset, that don't credit accounts payable, right? We need to credit the bank account because the bank account is going to decrease. So I'll give you some practice activities to reinforce that in the coming days. All right, so what happens here? We're purchasing a non-current asset, which in this case is a vehicle. So the vehicle cost, so this is very similar to product costing. All costs related to getting the asset into position and condition, ready for productive use, will be added to the cost of the asset, like they were added to the cost of inventory. So obviously the invoice price is definitely part of the asset's cost. Now stamp duty, necessary to acquire the asset. I have to pay it. The delivery, necessary, right, to get it into position. Tow bar and pack rack. So these are embellishments or improvements to the asset. So they are getting it ready for or into condition, ready for productive use. So they have to be included. Notice the 12 months insurance. Right? So that is not providing any economic benefit beyond the 12-month period, right? So that would be treated as a current asset. And we'll do that in the coming topics when we look at balance day adjustments. That will be treated as a prepaid insurance expense. So it's an economic benefit that hasn't been used up yet, but it's not a non-current asset, right? We're not adding to the asset's economic benefit to be extinguished over an extended period of time. This is 12 months. GST, as you know, is always dealing with the current liability. Right, so it's got nothing to do with the non-current asset. In this case, it's going to decrease the current liability because we're entitled to a refund. Right, so those two there have nothing to do with the cost of the asset, but the other four do. Right, so we need to record the purchase of the asset. Now, clearly the amount paid is your decrease in the bank account. So the decrease in the current asset. Right, and those four there represent the increase in the non-current asset. So you can hear Queen in the background playing We Will Rock You. Right, so non-current asset is the items that we can identify relate to getting the asset into position and condition ready for productive use. Any 12-month payments, so a service contract or insurance, these are current assets, right? We've got the economic benefit, but it's only for a 12-month period. And the GST is always going to the GST clearing account. Okay. And that's not a bad way of identifying one-off costs, right? So they're only paid once. So you're only going to pay stamp duty once. You're only going to pay delivery once. You're only going to put the tow bar and pack rack on once. But insurance, you're going to keep paying insurance. GST, you're going to keep paying in GST. If there was a service agreement, you'd keep paying it. If we replace the tyres on the vehicle, you're going to keep replacing tyres. They're not one-off costs. Right? When you service and maintain the vehicle, they're not one-off. They happen all the time. Right? So they're expenses or treated as current assets. Okay, so we've got a recording now in the General Journal. So obviously the first thing we want to record is the non-current asset, which is the vehicle, which is made up of those four costs. So 38,700 plus 2 is 40,700 plus 300 is 41,000 plus another 1,000 for the tow bar gives me 42,000. Right, so that's the cost of the vehicle. Then we have the insurance, which is prepaid insurance expense. And again, we'll be looking at that as a separate topic in the coming months. Right, so the prepaid insurance expense was for $840. And then we put in the GST clearing, which was 4,284. You then add all that up, and that will equal the amount that we're paying, which is 47,124. Right, so 47,124, and this entry will always be bank. Right, we are never going to accounts payable. Right, so don't get thrown. Don't look at it and think, oh, that's an invoice. It's not an invoice. It's a tax invoice. It's actually a cash payment. Right, so the bank account is what's going to be getting credited in every case in this particular topic. Right, so the bank account is going to be made up of those three things there. Now you can put it all as one item or three. Let's do it as three. It probably would be quite reasonable to do the vehicle / GST, but it doesn't matter as long as you get all the amounts in that add up to the total amount coming out of the bank account. And the GST. Now the other way we could have done it, we could have just gone vehicle / right, and then we just whack in over here 47,124. Right, so it's made up. So that amount coming out of the bank account is part vehicle, part prepaid insurance, part GST clearing. So each of those accounts is going to get those debits into it to cross-reference against that one credit. Right, so in the vehicle account, we're going to have the cross-reference will be bank, which will be 42,000. Prepaid insurance, we'll have the cross-reference, which will be bank. So they're all going to be cross-referenced to bank. And the GST clearing will have the cross-reference being bank of 4284. Right, and obviously the dates. 31st of May, 31st of May. Right, so that's the recording of the purchase of a non-current asset for cash. So in the bank account, whatever's been paid for on that invoice, that's the amount coming out of the bank account with the credit. Look, I think it's easy to just put it as one figure, but it just means you might have have to squeeze in a lot within one line or two lines to get all that in. And then you've got the three items which add up to the one credit. Right, so that's a purchase of a non-current asset. The key to remember is we are crediting bank only in this particular topic. All right, so with reference to your treatment of the tow bar and pack rack, a definition of cost will be all costs related to getting the asset into position and condition to earn revenue. So all costs related to getting the asset into position and condition. They will all be added to the cost of the asset. So even if we went and painted a logo on the side of this vehicle, the cost of that logo is getting the asset into position and condition ready for earning revenue. So the logo would also be debited to the vehicle. So you don't go to logo, you don't go to advertising. The debit will be to the vehicle because it's a position and condition. So exactly the same principle as when we did product costing. All right, so the effect of this document on the accounting equation. So we've obviously got I'll put it in stages. You've got a decrease in the bank account of 47,124, and you've got an increase of 42,000 being the vehicle. Right, so a net drop there of 5,124. Oops, sorry. There was also the prepayment as well, plus 840. And down here we have the decrease, which is the GST component, which was the 4,284. So the net change here is 4,284 as well. So this is an overall. Use the pen there. So this is an overall decrease, and this is an overall decrease, and we have no effect in there. Nothing in terms of owner's equity. There's no expense been recorded yet. We haven't consumed up any of the prepaid insurance. We haven't consumed up any of the non-current asset yet in terms of depreciation. So no effect on owner's equity. Also, as part of the study design, they also say that you have to, one of the dot points is that when you purchase a non-current asset for cash, you might have taken out a loan, which is often the case. So all you do is do the debit entry, which means the bank account goes up by what you borrowed, and you create a liability being the loan. So in this case, opposite to the purchase of the vehicle is how we funded it with an increase in the bank account. So don't know why, but they have it as a specific dot point in the study design, so you might get asked to do that, which I'm sure is not a problem for any of you, to record the new loan. Okay, so that's the first part, which is the the purchase of a non-current asset for cash. So we might just leave it there as the first part. We'll do a few exercises on that aspect before we move into the next topic, standalone topic, which is depreciation, where I'm going to look at what is depreciation, which is just a revision of what you did in year 12, and then year 11, sorry, and then we're going to have a look at the two methods of depreciation. So we're going to look at the calculation of straight line versus the calculation of reducing balance. So that's going to be important because that will give you an opportunity to do comparison questions, discuss questions, or impact on accounting reports using one method or the other. All right, so I'll leave that first part here, and I'll pick up the next part on depreciation.